Hello guys, let's do an example here. We are told that write the following in the books of accounts of Shell Enterprise. So I would want us we do ledgers for this. Then we are told March 1st started a business with cash over 1,000, with cash over 1,000. First I would want to explain what is a ledger. Ledgers are used to record double entry. They are used to do what we call double entry. Ledgers were formerly called T, capital T, the alphabet T, T accounts. This is because ledgers take a form of a T like this. That's why they were called T accounts. Then we usually have a debit and you have a credit. We shall use these ledgers to apply the dealer. We shall use these ledgers to apply the dealer principle. So I want us to record in the ledgers. Just to remind you, double entry argues this. Double entry argues that every transaction must do the following. Every transaction must affect two accounts. It must affect two accounts. It must affect two. That's why it's called double entry. And every transaction must be recorded twice. It must be recorded twice. That's why double. It also says that every transaction must have a debit and a credit. You can see this is also double. So this is what we call double entry. It simply argues that every transaction that occurs in a business must affect two accounts, must be recorded twice, must have a debit and credit. We have already said what is a debit and what is a credit. So the two accounts, one account will be debited, the other account will be credited. So one recording will be on the debit, the other one will be on the credit. That's why we are saying it's a double entry. I would want us to do an example, to do this example and we see. So let's do the example here. Let's do the example. So we are doing the double entry. It's a double entry and this double entry is for ledger. So we are told that Shell Enterprise now on 1st of March started a business with cash of 1,000. First I want to know which two accounts are being affected. The two accounts that are being affected for this transaction, one, from just the question, from the statement, the same statement, when you read started a business with cash, we know there is something that is being affected which is cash. And the other account here, the money used to start a business is called capital. For double entry, the two accounts being affected is one, cash. The second one is capital. The two accounts is cash and capital. Out of these two accounts, we want to see which one we debit and which one we credit. From our former video, we know that cash is an asset. When we start a business with cash over 1,000, that means the cash we have in the business is increasing. And when asset increases, it is a debit. When asset increases, it is a debit. The money used to start a business is called capital. Capital is also the equity. So when equity increases, it is a credit. When equity increases, it's a credit. That means for this single transaction, we shall debit, for this transaction number one, the two accounts being affected here, we shall debit cash and we shall credit capital. The two accounts here, we debit cash and capital accounts. Because every transaction must be recorded twice. First, we record it in the cash account and we record it in the capital account. This being a debit, this being a credit. Because when we are starting a business, the money we have used to start a business is called capital. That capital is increasing. And increase in capital from here is a credit. The cash we have at hand in the business is also increasing. So when the money we have in the business is increasing, which cash is an asset? It's a debit. So this is how we write this. So this one we shall write as follows. I will open here the account. sorry for that. I will open the account here. I will open the account called cash account. I have a debit side and I have a credit side. Then under here, I also open another account which we shall call capital. Capital account. We have a debit and we have a credit. Remember, every transaction must affect two accounts. One account will be debited, the other account will be credited. We have already known for this account, for this transaction, we are debiting cash. So with 1,000, the debit side of cash, I will write 1,000. The credit side of capital, I will write 1,000. You have seen that I have debited cash and credited capital. Debited cash and credited capital. What remains of me is to give narration. The 1,000 is debited in cash and credited in capital. So I need to narrate. The date here is 1st of March. So I write 1-3. Here 1-3. I need to show this money, where did it come from? This money, where it came from? This money came from capital. I need to show this money that was taken from capital, where it went. This money went to cash. So we have here cash. We have 1,000 here credited to capital account. The account is what is written on top. What is written inside is a narration. The account here is cash. What is written here is a narration. Do not confuse between this and this. What is inside here is narration. What is inside here is narration. The account is actually what is written on top. This is a capital account. It is not a cash account. You look at what is written on top. This was just a narration. This was just a narration. You also look at where the figure went. This tells you which account it affected. Where we have 1,000, it is the capital account. So let us do the second one. Here we are told bought goods on credit from A-Clicks. When you buy goods on credit, this is purchase. We record them in a purchase account. Take note, in accounting we don't have anything called goods account. We will never have goods account. We record that in purchase. Then, where the goods came from. The two accounts being affected in this transaction is one. For this one, the two accounts being affected is one. We have A-Clicks, where the goods came from because we bought on credit. The other one, we have purchase. So the two accounts being affected there, we have the two. When you purchase goods, you are receiving something of value, you are receiving an asset. So we will debit purchase because our goods or stock is increasing. Increase in asset is a credit. But for stock or for goods, we don't record in goods account. We record in an account called purchase or sales. If we have purchased, we record in purchase account. If we have sold goods, we record in sales account. Purchase accounts is only for purchase of goods. Only for purchase of goods or what we call stock. When you purchase a motor vehicle, don't record here. When you purchase any other asset, don't record here. Here you only record purchase of stock or goods. So here we debit purchase, we credit A-Clicks. Because when you have purchased on credit, our debts are increasing. We're increasing our debts to A-Click. Increase in a debt, which is a liability, is a credit. So what we do now, I will open these two accounts. Let me wrap this. I will open these two accounts. I will open these two accounts here. I will open the account called purchase. Here I have debit, here I have credit. And I open the other account called A-Clicks. Here I have debit, here I have credit. I have said for that transaction, we debit purchase. So the amount is 296. I go to purchase account, debit side, I write the amount. I'm supposed to credit this, and I can show this is a creditor. Creditor to show it's a liability. So we need to credit this. So on the credit side, I put 296. What remains of me is to give the date and to narrate. And I can give the date as follows. The date, 2nd March. I write 2nd March. I write 2nd March. These purchases, where did they come from? These purchases were purchased from Eclipse. This debt for Eclipse, where did it come from? This debt came from purchases. That debt came from purchases. Remember, the account is what is written on top. The account is what is written here, Eclipse. This is the account. Let's go to the next one. We are told paid rent by cash 28. Paid rent by cash 28. The two accounts being affected, we know rent is an expense. The two accounts being affected is rent and cash. The two accounts being affected by that is rent. And rent here, we need to be specific, is rent expense. Then we have cash. When we pay rent, it is an expense. It means you are the tenant. When you are paying rent, you are the tenant. When you are receiving rent, that time it becomes income. And we don't mix incomes with expenses. If you are to receive rent, you would have recorded in a separate rent income account. But since we are paying, we record this as a rent expense account. So let us record that in a rent expense account. Rent expense account. We know that when we are paying for rent, we are increasing expenses. Increase in expense is a debit. Our cash, which is an asset, is actually decreasing. When we pay rent, we are decreasing cash. Decrease in an asset here is a credit. You can zoom this. Decrease in an asset is a credit. So we have credit. So I need to credit cash account and rent. We already have cash account. What we don't have is a rent account. Take note, in an exam scenario, do not repeat to draw again cash account. We use what you have already drawn. We use this. So I will use this account because we already have cash account. So I draw rent account here. I have what we call rent. I have the debit, the credit, and here I write rent account. And I show this rent is an expense. Remember, I'm supposed to debit rent and credit cash. The amount is 28. So I write here cash 28. And I also debit rent 28. Then I show where the money went. This rent was paid on 3rd of March and it was paid using cash. This cash went to pay rent. That cash went to pay rent. Let's go to the next one. The next one we are told paid 1,000 cash into the bank. Paid 1,000 cash into the bank. The two accounts being affected here is cash and bank. We already have cash account. What we don't have is bank account. We know cash is an asset. Bank is an asset. When we are taking money from cash and putting into the bank, it means the two accounts being affected is cash and bank. Here, cash is decreasing because we are taking money from cash and putting into the bank. The bank is increasing. This is an increase, this is a decrease. The decrease in cash, which is an asset, is shown by a credit. So this one we shall credit, this one we shall debit. So let me open a bank account. So I'll open a bank account here. I can separate this. I will open a bank account. I have a debit and we have a credit. So on this side, we need to debit bank because the money is going to the bank. So we debit bank with 1,000. So I put this money 1,000 on the debit side of bank account, and then the credit side, on the credit side I put 1,000. On the credit side I put 1,000. So now what I need is to narrate. This date is 4th of March. 4th of March. And this money that came into the bank came from cash. This money that was withdrawn from cash account went to the bank. Look at how I'm narrating where the money went, but the account is what is on the top. This is the account. This is where the money went. This is where the money came from. So we are done with that one. Go to the next one. Here, we are told that sold goods on credit to J. Simpson. Sold goods on credit to J. Simpson. Sold goods on credit to J. Simpson of 54. So, like I said, the two accounts that are being affected, you get them from the sale. So here we have sales and you have J. Simpson. So the two accounts being affected is J. Simpson and we have sales. Because we are selling on credit. Now, when you sell on credit, when you sell goods, you earn revenue. Increase in revenue is a credit. Automatically sales is a credit. When you sell, what you get is a revenue. Increase in revenue is a credit. Simpson will receive goods. In other words, Simpson will receive an asset. And increase in asset to Simpson is a debit. So we debit Simpson, we credit sales. We don't have Simpson account and we don't have sales. So we open those two accounts. So I want to open Simpson. So I'll have J. Simpson. Then I'll also open sales account. Here is a debit, this side is a credit, this side is a debit, this side is a credit. So we have agreed that you credit sales and you debit Simpson. The amount is 54. So we debit Simpson with 54. We credit sales with 54. I need to narrate where these goods were sold to. The date is 5th of March. So I say 5th of March, these goods were sold to J. Simpson. And here I narrate 5th of March, this money went, this debt to Simpson arose from sales. And we know Simpson will be called a debtor. And debtors are assets. Debtors are assets. We can have the next one. Bought stationery, 15 shillings or 15. Bought stationery of 15. Paid by check. So here we can tell the two accounts being affected from this question is stationery and we have check. Stationery and we have check. So when you are paying for stationery of 15 shillings, it means the stationery expense is increasing. Remember, the stationery expense is increasing. So here we have stationery and we have bank. Stationery is an expense. We are increasing our cost to stationery, our expense. So increase in an expense is a debit. So stationery account will debit. The money we have in the bank will decrease, and the bank is an asset. Since bank is an asset and the money is decreasing, it's a credit. So for this single transaction, we credit bank, we debit stationery. You can see we debited stationery, we credited bank. I want us to do now this cash sales of 49 shillings. The two accounts being affected, you can see it is cash and sales. So here the two accounts being affected is cash, and we also have sales. We also have sales. When you sell goods, you receive cash. When you receive cash, it means cash is increasing. Increase in cash is increase in an asset. So it's a debit. So we shall debit cash and we shall credit sales. Because sales is an income. Increase in an income or revenue is a credit. When you sell, what you get is revenue or income. Increase in revenue is a credit. So we credit sales account, we debit cash. We already have cash account, we have sales account. So I need now to do the following. 11th, I say 11th of March, credit sales. I credit sales with 49. I go to cash account and say 11th of March, we have 49. I need to narrate where this money came from. This money came from sales. Then I need to narrate where these sales, how these sales were made. These sales were made using cash. These sales were made using cash. This money came from sales. Remember, it is going to cash account. Remember, this is the sales account. So we are done with this. The next thing, we are told that goods returned by us to A clicks. Goods returned by us to A clicks. Goods returned by us to A clicks. When we return goods, we record in an account called return. And these things we are returning to is called return outwards. We return from our warehouse to somewhere. So this is called return out. A clicks is the person receiving the goods. So the two accounts being affected there, the two accounts being affected is one, we have A clicks, the person receiving the goods, and we have what we call return out. We have what we call the return outwards. For this return outwards, since we are losing stock, which is an asset, we are losing stock, which is an asset. And when there is decrease in an asset, when there is a decrease in an asset, what we do is that we credit. Decrease in asset is a credit. So we will credit this. Automatically, A clicks will be debited. Because this person is receiving an asset. Is the one whose assets are increasing. So we debit A clicks. We debit A clicks. Remember, A clicks was actually our creditor. So we are reducing also the liability that we are supposed to have, the debt that we are supposed to pay this person. So the amount is 17. So I'll come here and say, I'll come here and record that as follows. I say on 14th of March. Then I also have, I open the account called return out. Return outward account. So this account, it has a debit, it has a credit. Return outward account, I have to show the 17 is supposed to be credited here. So we credit this account with the 17. Then A clicks, we are supposed to debit. I need to show this where it went. So this went to return outward. This return on 14th of March was taken to A clicks. We continue. Here we are told that sold goods on credit to Pilates. Sold goods on credit to Pilates. The question will tell you the two accounts being affected. Here we have sales and we have Pilates. Just from the same question, we have sales and we have Pilates. So we have the two accounts here. We have Pilates and we have sales. Pilates and we have the sales. Now, Pilates is the one receiving an asset. Since the assets are increasing, this one we debit. Sales, we are increasing our revenue. Increase in revenue is a credit. So sales account is credited, Pilates is debited. I will open those two accounts here. I will open the two accounts. I already have sales account here. So what I need to open is Pilates. Pilates account. Pilates, I have a debit, I have a credit. So for Pilates, we need to debit. And we are debiting with 29. So on the debit side, I write 29. On the credit side of sales, I write 29. And I specify that on this 17th of March, we sold to Pilates. And here I show that what happened here is actually that we sold sales. So this person is a debtor. He will pay us at a later date. That person is called a debtor. So the next one, you are told paid repairs to building by cash 18. So when you pay for repairs, when you pay for repairs, it means our repairs are increasing. So here we have two accounts, repairs and we have cash. Repairs, the repair, it means we are incurring a cost or we are repairing. So there is increase in an expense. Increase in an expense is a debit. Our cash is reducing. Decrease in an asset is a credit. So with that amount of 18, we debit repairs and we credit cash. So I will open the account called repairs. I will open the account called repairs. Here we have a debit, here we have a credit. So this account called repairs, a debit there. So we need to debit with 18. In the cash account, I need to credit with 18. I need to show where this money went to. So we have 20th of March. These repairs were paid using cash. 20th of March, this money went to pay repairs. Then we are told J. Simpson returned goods to us worth 14 shillings. So the two accounts being affected there is J. Simpson. When we are the one receiving goods, these goods are coming to our warehouse. So these goods are called return inwards. We record them in an account called return inwards. Those goods that have been returned to our warehouse, we call them return inwards. So we are receiving stock. Increase in stock is a debit. Simpson is actually, Simpson here, we have J. Simpson is a debtor. Debtors are assets. When he's returning goods, we are reducing in assets. So we have creditors. We credit that. We credit J. Simpson. So I need to credit J. Simpson the amount he has returned. Is he has returned amount worth 18. Then I open a return inward account. Inward account. So we have a debit here and we have a credit. So we are supposed to debit 18 here. So here we have the date is 20th of March. We have a date 20th of March. These goods went to return inward. These goods came from J. Simpson. J. Simpson. We also told that paid air clicks by check 279. The two accounts being affected here is air clicks and check. The two accounts being affected is air clicks. We also have check. Remember, check, here we use the account bank. Remember that when we are paying air clicks, the money in the bank is decreasing. Decrease in an asset is a credit. Increase, here we have decrease in liability, which is a debit. Decrease in liability, because air clicks, we had a debt with air clicks. So this one is a debit. So we go to air clicks, we debit. So we are paying this person, air clicks 279. So here we write the 279. Then we go to the bank, we write 279. The date is 27th March. He was paid using bank. Here, 27th March, this money went to pay air clicks. The next one, we are told that cash purchases of 125, cash purchases of 125. So that means the two accounts being affected is cash and purchases. So when we make purchases, we are reducing cash. Cash is an asset. So we credit cash, we debit purchases account. We credit cash, we debit purchases account. We already have purchase. We are receiving stock, so we debit purchase. We are losing cash, which is an asset. We are losing cash. When you decrease asset, is a credit. So this amount appears in cash here, 125. The date is 28 March. This is purchase. Then here we also have purchase account, 28 March. This was done using cash. The amount is 125. The amount is 125. We also told bought motor vehicles paying by check, 395. Bought motor vehicles paying by check, 395. 395. Bought motor vehicles paying by check, 395. When we are buying motor vehicle, we are increasing motor vehicles. Increase in asset, we debit motor vehicle account. So here, I will open a motor vehicle account. So here we have a debit, we have a credit. I will open a motor vehicle account, we have a debit, we have a credit. So motor vehicles are increasing asset is a debit. So here I have 395. I also go to the bank. The money in the bank is decreasing, I credit 395. 395. Because the money you have in the bank is decreasing. Then I show this money was used on 29th of March to buy motor vehicle. I can write M vehicle. Then I can show that 29th of March, this motor vehicle was bought using bank. Here we are told paid motor expenses by cash 15. The two accounts being affected here is cash and motor expenses. The two accounts being affected here, now I can wrap this. The two accounts being affected is cash and motor expenses. So here we have cash. I can write this account somewhere here to utilize my space. We have cash account. Sorry, we already have cash account. What we don't have is motor expenses. So I write motor expenses. Motor expense account. This motor expenses account, I have debit and I have credit. So we are paying cash of 15. It means cash is decreasing, expenses are increasing. So I debit the expense account. Increase in an expense is a debit and cash is a credit because we are losing money. So here we have 30th March. I write this is motor expense. Motor expense. Then here I write the date 30th of March. This was paid using cash. The last one is that bought fixtures on credit from R West. Bought fixtures on credit from R West. Bought fixtures on credit from R West. So when you are buying fixtures on credit from R West, the two accounts being affected here is R West and fixtures. R West and fixtures. So for R West, we need to open an account. So I will open this account that we call R West. Debit and credit. Then to spare my space to do a trial balance here, to spare my space, I write it here. I write fixtures here. Fixtures account. Here I have a debit, here I have a credit. When you are buying fixtures, we are receiving assets. So I debit fixtures account, which is 120, and I credit R West, which is 120. And I show this debt is from fixtures. 31st of March, maybe I can draw a big account. Here we have R West account. So I say that the 1st of March fixtures. For fixtures here we have the amount is 120. Then here I have 3 March. 31st March, this came from R West. This is also R West. Now we are done doing the ledgers. What remains is to do what we call balancing of accounts. Balancing of accounts is getting the totals. Balancing of accounts is getting the totals of each account, then doing balance carried forward. I'll do the balancing here. So I'll look at the cash account first, which has the credit as 28 plus 1,000 plus 18 plus 125 plus 15. The total here, we have 28 plus 1,000 plus 18 plus 125 plus 15. The total here is 1186. So I'll write the total here. 1186, this is 1049. So this side is more. This side is more. So the side that is more, you write here. This side is 1186. This side is needs to be 1186. So I minus 1049. That means my balance carried forward is 137. So that to make this side 1186, I need to add this side 137. 137. I do the same for this. This side has 1000. This side needs to add what? To have 1000. So I have 1000 here. I need to have 1000 here. So that means here I will add something called balance carried forward 1000. This side has a total of 296 plus 125. This side has a total of 421. I need this side to be 421. So I add balance carried forward here, 421. This side has 279. 279 plus 17. This side is 296, 296. So this account is balanced. It doesn't have a balance carried forward. 96. This account, I need this side to have 28. This side I also need it to have 28 to balance. So I need to add here balance carried forward of 28. This side, I need it to have 120. This side should also have 120. So here I add balance carried forward 120. I look at which side has more here. Automatically I can see this side has more. So here I need this side to be 1000. This side needs to have 1000. So we have 15 plus 279 plus 395. So that is 689. 1000 minus 689, this side needs to be added 311 to be 1000. I call this balance carried forward. This side has 54. This side 54. I need this side to be 54. So that is 54 minus 18. I need to add 36 here, which is balance carried forward. This side is more. So we have 54. You can make it a little bit. Here we have 54 plus 49 plus 29. This is 132, 132. So my balance carried forward is 132. This side is 15. I need this side to be 15. So this means balance carried forward is 15. This side has more of 17. I need this side to have 17. So this means we shall have balance carried forward of 17. This side has 15. I need this side to have 15. So that means I will have balance carried forward of 15. This side has 29. I need this side to have 29. So here we have balance carried forward of 29. This side is more with 18. I need this side to be 18. So here I add balance carried forward of 18. This side has 18. This side should also have 18. So here I add balance carried forward of 18. This side has 395. I need this side to have the same amount, 395. So I add here balance carried forward of 395. This side, this credit side has 120. 120. I need this side to have 120. So that means here I need to have balance carried forward of 120. When you are done writing this, the next step is to do what you call balance brought forwards. So balance brought forward is guided by the carried forward. If carried forward is here, balance brought forward is on the opposite side. balance brought forward. It comes after the total, which is 137. Balance carried forward here, balance brought forward is here, 1,000. Balance carried forward here, balance brought forward is on the opposite side, balance brought forward is 1,000. Sorry, it's 421. Here we don't have balance. Here we don't have any balance, so this one we will not write anything. Balance carried forward is here, so balance brought forward will be here. Balance carried forward is here, balance brought forward is on the opposite side. Balance brought forward is here. For this one, balance carried forward is here, brought forward will be on the opposite side. Balance brought forward is 311. Balance carried forward here, balance brought forward this side. Just after the total, brought forward 36. Balance carried forward is here, balance brought forward is here, 132. Opposite side, this one opposite side. This one opposite side. This one opposite side. This one still the opposite side. This one the opposite side. The same opposite side. This one's the same opposite side. This one the same opposite side. Now, when you are done writing this, what remains is for you to do a trial balance. What remains is for you to do a trial balance. So I'll do my trial balance very easy. Trial balance, I'll do in this space. So here, I will avoid writing the title and just write a simple word, trial balance. I will not write the time frame, even though it's compulsory to write the time frame because of my space. I'll do it in this format that is a T. Here I need to have a debit for trial balance. Here I have a credit. Any account that has a debit balance brought forward appears here. So let's see. This is a credit. It will appear here, cash. The amount is 137. This is a credit, capital. On the trial balance, we take the balance brought forward, 1,000. This balance brought forward is a debit. So here we have purchase. Here we take 421. This, here we don't have a balance brought forward. So this will not appear in the trial balance. Any account that does not have a balance brought forward does not appear in the trial balance. So here we have rent, because on the debit side. So here we have rent, we have 28. Here we have fixtures. Fixtures, we have 120. Here we have bank, debit. So I will have bank. Bank is 311. Here we have J. Simpson, 36. Debit. J. Simpson. $36. Here we have sales. Sales is 132. Here we have stationery, 15, which is a debit. Here we have return outward. The balance is on the credit, so 17. Here we have motor expenses. The balance is here, right, 15. Here we have pillars. I still write pillars. This is 29. Here we have repairs, 18. Here we have return inward. Return inward is 18. We have motor vehicle. Motor vehicle, which is 395. Then last and not the least, we have R West. which is 120. So what remains is for us to do the total. So we have 137 plus 1000 plus 132 plus 17 plus 120. So we are doing the total. We get the total of this. So we have 421 plus 28 plus 120 plus 311 plus 36 plus 15 plus 15 again plus 29 plus 18 plus 18 plus 395. So the total of here, you also get, the total is 1406. Now something to take note. If you have gotten, for the trial balance, if you have adhered to double entry, the figure on the credit side of the trial balance and the figure on the debit side will be equal. We'll have 1406 and here we have 1406. The two figures should be equal if you have actually adhered to the trial balance. You can see that's how you do ledgers and that's how you do a trial balance. Next lesson, we'll look at from the trial balance, how to do income statement and how to do a balance sheet. Thank you. I want to show you common mistakes that you do when you are doing ledgers. One of the mistakes is writing this total, one total up here and the other total here. The totals here should be the same line. You can see, if you draw a line like that, the total should be on the same line. These two lines should also almost be on the same line. Every account, when you are closing the account, it should be followed by two lines. These two lines means the account has balanced. That is, the account has the same total here as the total here. That's why you draw two small lines like this. The other easy error that you do is to forget this. If you forget this, you can easily forget that. If you look at the way I've written this, they're almost the same point. The way I've written these two lines here, they're almost the same time. Do not write 421 here, that you have one total here and the other one is here. This one will be wrong. Don't do that. Let them appear on a straight line. That here, it's almost a straight line. We have 421 here. Those are the common mistakes. When you are writing balance brought forward, let it be on the opposite side. Carried forward is the balance that is inside the ledger. Brought forward comes after the total and after these two lines. Those are the common mistakes that people do when they are writing ledgers. That is, you write balance brought forward here, balance carried forward here, or balance brought forward here. Balance brought forward comes after this total. So take care as you do ledgers, not to forget this. The other common mistake is that you debit one account, like this 421, and you don't put it in the other account. You can see, like this 296, you put in the purchase, but you forget to put in A clicks. That one will make your trial balance not to balance. So every account you have written here and every figure should be accompanied somewhere else in the ledger. If you look at a figure like 1,000 here, it is also appearing here. If your trial balance doesn't balance, the first thing you check is whether every figure appearing here is appearing twice. If it is this, is it appearing in J. Simpson? Tick. Then you also do the arithmetic confirmation on each account to see whether the balances are actual. Thank you.